Daniel here, Gen Wealth Concepts. What I'm going to talk about is, and I've kind of touched on this a little bit. I talked about how you could buy your cars with your life insurance policy. Well, how about just paying off all of your debt, including whenever you go to buy cars and things like that? The way I look at it is, one, you should have life insurance anyway. I mean, that for a lot of people, they consider it something that's not necessary, or maybe it's just an additional cost. So if you were to be able to put money into your life insurance policy that you would probably pay for anyway in some capacity, and get cash out of that, or I shouldn't say out, because you're borrowing against it. And all the time while you borrow against it, the money in there is still growing. The full amount of money that you have in cash value is still being credited based on the full amount. Even though they reduce the cash value and the death benefit based on your loan, you still get paid on the full amount. So I know that sounds a little confusing, but you're basically getting interest paid on that whole amount of money. So say if you have $20,000 in cash value, you'll get paid on $20,000 in cash value, even though you may have it borrowed against and using the $20,000 for something else. So that's a beautiful thing about it. You keep getting that interest. It'll compound year after year, and it'll continue to grow. Well, at the same time, if you're putting money into your policy and then you're using that, and some people are like, well, you're borrowing at 4 or 5%, depending on the company. You know, my mortgage is 3%. Well, that used to be the case. Everybody who's getting mortgages now is not getting that, first of all. Second of all, think of it more as a bill consolidation. I mean, how many people have done bill consolidation loans over the years, or you've heard of it? They do it because even though it's a 6 or 7% rate, they're consolidating as much as possible into one payment, and it lowers their payment. So the whole idea with this is not so much that it's lowering your payment, but it's creating an arbitrage of money. So you're paying yourself back, and that amount increases. So say you pay off a credit card, and it's kind of the snowball, the debt snowball. You're paying the smallest one first. So say you pay the small credit card, and it's either $500 or $1,000. You pay that off first. And mind you, it depends on your cash value. Maybe you have more cash value than that. Maybe you had $5,000. So you paid the small one first. You paid the next one up, which may be $2,000, and the next one up, that might be $2,500. So now you've got your $5,000, and all of those payments you would have paid collectively across those 3 credit cards, you're going to pay that back into your policy or into a side account, which that depends on you, and it depends on the frequency of everything. I usually just set up for myself and for my clients, I set up if I was going to do something like that, I would set up an auto debit. So the insurance company will automatically debit you every single month, just like you would probably do with your current bills. So your current credit card payment, your current, whatever it is, whether it's mortgage, whether it's credit cards, you would go in and have this money going back in there. And so you're making this payment. And then, annually you would still have your premiums, or maybe it's monthly. Maybe you're paying a monthly premium. But mind you, you're not paying extra. You were already going to be paying on life insurance, or you were already going to be paying maybe the life insurance, basically what you should be doing is the life insurance is used as a savings account, because it's a savings asset technically, and it's a tier 1 asset. So you're able to have your money safe, it's liquid, and you're able to, it's protected. So when I say safe, it's protected. So it depends on your state, of course, but most states it's protected. And then it's liquid, so you're able to access cash from that insurance policy or against that insurance policy through the insurance company. You don't have to do an application, you don't have to take a loan. or specific loan process. The loan process is you fill out a form and you ask for whatever amount is available or the max amount available, and it's in your bank account in 2 to 3 days. So anyway, whenever you do this, you're accumulating more and more cash. And so then you pay off the next biggest one, the next biggest one. And even if your mortgage is 3 or 4%, it's a lower interest. You have to run the numbers because the mortgage mortgage interest is amortized, which means that most of that is in the first 5 to say 7, 8 years. So most of that is interest. You don't have a whole lot of principal that gets paid down, especially the first few years. It's almost all interest. So you have to weigh what the simple interest would be, the simplified annual interest on the loan through the insurance company at, just say 5%. But if 5% of $10,000, is $500, what does that cost per day? Because then you split it up amongst 365 days. Now, if it carries over to the next year, yes, and you don't pay the interest, or there's no interest paid down, which there will be if you're making payments into it, it'll automatically pay down some interest. Yes, it will compound that interest, but in most cases you have this snowball effect of money going into the policy every month. So if that money goes into the policy every month, then you're getting credited back a certain amount of interest that they prepay. With most companies, they'll prepay it. So if you take out a loan for, say, $5,000, they will keep the interest that you would pay for that year. Anyway, that's getting a little more technical, but the idea is that if you're able to pay off your bills and not have to pay any more money than you're already paying, why wouldn't you do that? For most people, being debt-free is huge. Then there's the flip side. I have other clients who are like, I don't want to pay off my debt. I have low interest, or I don't mind the opportunity costs, and I will pay that. I'll pay it all day long because I'm going to take this money that I'm putting in here. It's growing at, say, after expenses and everything, say 4%. And if it's growing at 4% year after year after year, so it's constantly growing. But instead, what they're going to do is, whenever there's cash available to them, they're going to take it out and they're going to buy some sort of asset that's going to create some sort of cash flow that is going to pay back the loan eventually. And they also have the asset. So it is, and they have the additional income. So it can be done a couple different ways. Probably even more than that. I mean, most of it's either buy assets or pay off, your debt. And then once your debt's paid off, and then buy the asset. It just depends on your philosophy. But for some people, there's safety in not having debt. There's safety in, if I ever am in a bad spot when life happens, then if life happens, you don't have to worry about that. You don't have to worry about my, how am I going to pay this bill or that bill? It's already paid. It's already paid off. So, everybody's different. But that's a general idea. You are able to never have to pay any more money than what you're already paying. If you're already saving money, for example, you're just putting that savings into this vehicle and then making your money work twice as hard. You're saving on interest, and then it's growing while it's in that policy. So you can use the money while you're living. It's a living benefit. In most cases, you have critical illness, chronic illness, and terminal illness coverage, which covers up to the full death benefit. It doesn't matter how much cash value in there. Well, I say it depends on the company, but some are 50 to 100%. So it just depends on the company. But you're able to access the death benefit. And that's huge too, because say you get cancer or something and you need a large cash infusion for your treatment. You're going beyond the coverages of your health insurance. What if you have health insurance, you're able to utilize this. So I'm getting way off track because there's many benefits to having these policies. And then structured properly, there's even more benefit because of the growth. And then on top of that, if you're able to leverage it to still grow, but use the money and to pay off your debt or make purchases, say you buy a home, say you buy your cars through this and you do it that way. At the end, whenever you're done paying it off, depending on what the payment schedule is, you choose the payment schedule. There's no one telling you when you pay it off. But if you choose the payment schedule, then you're able to have, say, the car and the money back. Yeah, you paid some interest, but you have both. You have the money and the car, where if you borrow it from the bank, you have the car and you don't have the money. I mean, in theory, because you paid them all the interest, you didn't in all the principal. So there's no principal that you recaptured. And there's, depending on the interest rate, especially right now, as of, the filming of this video, you would probably have a lower interest rate in a lot of ways, depending on a lot of factors, your credit, the bank that you use or credit union. There's a number of factors, but still, in a lot of cases, it may be a better rate. You may be getting 10% car loans now, where you could do it for 5%. There again, unless you feel like you'd rather have a cash flowing asset. But anyway, please like, subscribe, click the notification bell. Any questions about this, get on my calendar. The link's below. This is one of the most awesome ways to pay off your debt and pay it off a lot quicker than you normally would. I've had clients that, they're on schedule to pay off, large amounts of debt, including their homes, within, say, 7 to 10 years, depending on the individual and their cash flow and how it's set up. I mean, it's going to depend on how much is going into the policy and a number of things, but it's much quicker than the 30 years that it would take them to pay off their mortgage. So, either give me a call or get on the calendar and we'll discuss your situation, and then we'll run it through the software, show you what that plan looks like, and go from there. Have a great day.